All right, welcome everyone. This is Jeff here with FX Mindshift, and today we're going to be doing an introduction to the market maker cycle. So let's get started here. The first question that is on everyone's mind is, what is the market maker cycle, right? What exactly is it? The first thing that you guys have to realize, okay, is that the Forex market is rigged. The sooner you guys understand that, the better off you'll be, because then you'll understand how to kind of trade the way that you should be trading, and not against the big players. So there's two main groups of traders in the market. There's the retail traders, which is 90% of the people, which are people like us, and then there are the market makers. So these guys are, the dealers, the brokers, the hedge funds, the big banks. These are the guys that you're trading with, and these are the guys that are trying to take your money. So this market maker cycle is basically a cycle that can be found on all time frames, with a specific pattern that repeats, that you can exploit, right? If you were able to trade in line with the market makers, with the big banks, you would be a lot better off, because then you wouldn't find yourself going head on against these big players that actually control and move the markets. Okay, so my goal for you guys today is for you to be able to identify the pattern, trade in line with the market maker, and then also learn to spot the different variations of the pattern. Because if I just show you a pattern and say this is what you need to look for, obviously that would be a little bit too easy, right? You just look for the pattern, and you could exploit it. But the market makers are tricky. Okay, they tend to vary things up, and they tend to like to trick us. So that's what I'm going to go over today. I'm going to show you guys basically how they do what they do. Okay. So let's talk a little bit about the market maker objectives. Okay, what are they really trying to accomplish? So really, what they're trying to do is the first thing is to induce traders to take positions. Okay, because if you have money sitting in a trading account, it really does no good to them until you trade the money, right? So you need to take a position, and they're going to try their best to get you to do that. Okay. Once you are in the position, okay, once you've taken a trade, you might be holding it for a bit, and then what they'll do is they'll kind of create a panic and a fear, right? They'll try to get a trader to think irrationally and do things that they wouldn't normally do with their money. So they can do this, with news spikes. They can do this, with big shift candles, and you can see those on the charts sometimes. Just a big candle out of nowhere, and you don't know what's going on, and then you either cut your trade in a loss, in a big loss, or maybe add a position and over leverage and over margin, and that's what they do, right? They'll hit your stop losses, they'll clear those orders, they'll force you into margin trouble, and they pocket your money. Okay, so those are really what the market makers are trying to do with your money. These are the objectives. Okay, so induce traders to take positions, create a panic and a fear to get traders to think irrationally, and then they'll hit the stop losses, clear the orders. If you don't have stop losses there, they'll force you into margin trouble, and then eventually, if you're over leveraged, you're going to blow your accounts, right? And they pocket your money. Okay, so let's take a look at what happens in a typical day in Forex. Okay, so we have three sessions. The three big sessions are the Asian session, the London session, and then the New York session, right? And then it just repeats. So the Asian session usually is the accumulation phase. Okay, this is where the initial high and the low of the day are set, and that's the initial high, right? Not the final high and low. But during this phase, they kind of trade within each other, and just kind of create this range, this high-low range for the day. Okay. Then what's going to happen after that is you're going to get some kind of stop hunt, okay, or a false move out of the Asian range, okay, which is against the intended real move. This happens usually in London session. So Asian session ends, London session starts, and then there's this false move out of the Asian range against the real intended move. Following that, there's the trend move, which is the real move, and that usually goes for about 6 to 8 hours, slow and steady, right? And then the London session will end, and then following that will be the New York session, which usually you'll get a reversal off the high or the low back into consolidation to end the day. Okay, and then the whole thing repeats again. All right. So what are the trading hours that these happen in? We're going to talk about the hours in Eastern time zone. So all of these are in Eastern time, all right? So starting off, the market closes at 5 p.m., okay, and that's when the high and the low reset, right? So the previous day's high and low are reset here. There's a end of day gap time between 5 p.m. and 8 p.m. This is like a dead gap time. There's really no activity going on here. Just waiting for the Asian session to start and trading desk to start, right? So Asian session starts at 8:30 p.m. to 3 a.m. and this is what we talked about just before about the accumulation phase. Okay, so banks and other market makers will trade amongst themselves. It's called circular trading, and they'll kind of just collect contracts and pick up orders, and just create this little range in the initial high and low of the day. All right. Then the London session starts at 3:30 a.m. to about 9 a.m. Okay, and then that's where you're going to see your stop hunt move, the false move, and then the trend move, right, for the real move of the day. All right, and then as London session comes to a close, New York session starts, okay, at 9:30 a.m. to 5 p.m. to end the day, and that's where you're going to get your reversal and the end of day consolidation. Now, you're also going to notice that there are small gaps, okay, in between the sessions. So between Asian session and London session, there's a half-hour gap, 3 to 3:30, and London session 9 to New York session 9:30, there's a half-hour gap. So what happens between those gap times is that the market makers in the Asian session are ending their day, and they have to discuss what their goals and their targets are for the day, and pass those along to the guy that's taking over in the London session, right? So session changeovers, okay, information is being passed between the market makers to basically relay what the goals and the targets are for the day. So, the London session guy is getting off at 9 a.m. and he may pass on to the New York session guy saying like, okay, so to end the day, we need to collect another $500 or $500 million in contracts in, the euro pair or the pound pairs, and that information will be relayed to the New York session guy, and then he'll have his targets for the day. So that's where those gaps come in, just in case you were wondering. All right, and if you guys are taking trades and you're, doing your chart analysis and things like that, you really want to be looking to take the trades during London session open and New York session open. Those are really the only two times you should be looking for opportunities and setups, because those are when the markets are gonna move, and that's when the setups happen. Okay, so take particular special attention to those times and trade only those times. That's my recommendation. So let's take a look at how this looks on an actual chart. Okay, so this is the pound yen, GBP, JPY. All right, and this was actually last Thursday. All right, so you can see here the blue box on the screen represents the Asian phase, or the Asian range, excuse me, and the red box represents the New York session. So, and then right in between is the London session. So you can see in the blue box area, that's the accumulation phase in the Asian session, and they're just kind of setting the high and the low, trading in a small range amongst themselves, and it creates this box, right? And once the Asian session ends, you're going to get the false move, like I said, the stop hunt. Okay, what they do is they break out of the Asian box. Okay, they move pretty quickly, as you can see, down to the low there. And that's a stop hunt, right? That's the false move against the real intended move, which you can see happens right afterwards. Okay, and then they shoot right up. It's a pretty big candle, right? Into the New York session, okay, which brings the reversal, okay, and then we're back into consolidation. All right, so that's a typical typical forex day, and you can see the three different sessions there pretty clearly. Okay. So the phases of the market maker cycle, basically what I had explained earlier with the objectives, right? How do they do it through the cycle? Okay, because the cycle is really how they accomplish their objectives. So they induce, they trap, and they shift. Okay, let me go over those quickly. So the three levels of rise or drop is the inducement phase. Okay, so you'll see on a chart that generally they like to rise 3 levels before they make the shift, or drop 3 levels. Okay, and you'll see that the number 3 plays a very big role in the charts. Okay, lots of things come in threes. Psychologically, we just kind of gravitate to the number 3, and the market maker uses that against us. okay, because you'll see that on the third level is where they trap us, okay? So once they induce you into the trade after the three levels of rise or the drop, getting you to think that the market is going to continue in that direction, you're going to see the trap happen, which is an M or a W formation, and usually at the high or the low of the day, okay? And they trap you at that level, and then they'll take it away from you, okay? Then they'll shift, they'll reverse back to the range, and then go into consolidation, and leave you, stuck in that trade. Okay, so induce, trap, shift. All right, so let's go back to our chart again. I'm going to show you exactly what that looks like on this chart. So back to the GBP JPY, you can see in the Asian range, okay, the blue box, we have 3 pushes down, all right, to induce the traders to go short. That's our false move out of the Asian session, right? If you see that on a chart, if you're unknowing trader, a retail trader learning all the technicals, all the books and things like that, when they tell you that a trade is breaking out like that, you're taught to go short, right? Continue the trend, and take that short. What happens is after the third push, you can see that they issue a nice set of railroad tracks there, which is that long red candle followed by the long green candle. Okay, so they went down to the low. They trapped the traders that were going short. Okay, then they basically pulled back immediately. Okay, so all the traders that were taking that short down there are now trapped and stuck in a drawdown. Okay, then what they do is they'll hit it again, right? They'll come back down to the low, but they won't actually come back to the low and take it out. Because if that happens, what they do is they'll release the people that had their stop losses at break even down there, right? So they don't want to release that volume. They don't want to let those traders go that had their shorts down there to get out at break even, right? Or get out with a small loss there. They want them to keep them in that drawdown. So what they'll do is you see those three, kind of doji candles there. They just kind of hang around at that level, and that accomplishes two things. Number one, it keeps those people there, right, in those trades, thinking that this trade will continue to go down and get them out. And it also induces more people to go short because they're holding that level and they're hanging around down at the bottom there and making people think that this is going to go down, right? But then you can see right afterwards is a nice big green shift candle out of the zone, okay, trapping the sellers down there, making the W, as you can see, and then coming right back out, and they got the hell out of there, right? So it's a really bad situation that you're in if you took that short. If you didn't have stop losses there that got taken out, then you are in a big drawdown right now. And if your account is over leveraged, you probably blew your account. All right. So then they go back up into the New York session. We have our end of day reversal. So you can see the reversal there, and then back into consolidation. Right. So actually, on the flip side, when you're going into the New York session, this is also inducing traders to go long, right? So you can see those big candles going up, getting people to think that this is going to keep going up and going long, but then what they do is they reverse back and then they go into consolidation and trap those traders long as well. So it's twofold, this move, right? They trap the traders short and they trap the traders long going up, so at the high and the low of the day. So you really got to pay attention to the highs and the lows of the day, okay, and then look for the traps and the formations and the candlestick patterns at those times. All right. So taking a look at the market maker cycle on a weekly scale, okay. So if you kind of zoom out and look at this on like an H1 chart, you can kind of see that the market maker cycle looks kind of like this, okay. So this is really the pattern that you are looking for. All right, you're going to have some kind of peak formation. Then you're going to have the M at the top, and then 3 levels of drop, right? Followed by the peak formation low, which will form a W. And then, on the flip side, obviously it's just going to look the same the other way, right? So the peak formation low at the W, 3 levels of rise, followed by the peak formation M at the top, and then down. Okay, now this is not going to look like this, perfectly like this every single time, but there's going to be variations, and there's times where it's going to look pretty close to this. Okay, so let's take a look at on the real charts again. Okay, this was USD JPY just a couple weeks ago, And you can see clear market maker cycles on this chart right here. And so you can see there's on the left here, there's a peak formation M, 3 levels of drop, okay, down into the low of the week, into a W, followed by 3 levels of rise, and then a peak formation M, and then reversal into consolidation, right? So the cycle is there, and if you look on the charts and you take a look on a few different pairs, you'll see the cycle there. You just have to learn to recognize the pattern. So you can see it pretty clear here on the USDJPY, right? So in contrast, this is what the retail trader sees, right? The retail trend is seen by the herd simply as a rising channel that will keep rising, okay? But with the market maker cycle, we know better. The market maker trend starts once the M on the top locks and the count starts to run lower, right? So, but if you're a retail trader and you're learning the technicals and you're reading the trading books, they teach you to trade these breakouts. Once they pass the resistance or once they bust through the support, you're taught to take the breakouts and continue the trend, right? Trade with the trend. But if you don't understand the market maker cycle and you don't know where you are in the cycle, this could work against you, right? So if you're taking a breakout at the top, of the M and it breaks through the resistance and you take that trade, you're going to be in drawdown. You're either going to blow your account if you don't have your stop losses in place. A lot of traders get tricked, because they don't understand the cycle. So that's where learning the cycle and knowing the cycle will help you when you're trading and save you a lot of money, right? So when you're looking for trade setups, okay, there's a couple criteria, right? Once you have identified where you are in the cycle, you can drop down to a lower time frame and find a trade setup or an entry, okay? So ideally, what you want to watch for on the H1 and the M15, those are recommended time frames to watch for, okay, is you look for your directional bias on your H1, and then you drop down to your M15 for your entry, either at the second leg of the M or the W formation, okay? So that's basically, I just want to kind of give you a basic setup for you guys to look for. Obviously, there's more detailed and more advanced setups to take once you learn the cycle and the nuances. But for now, this is what we're going to look at. Okay, so this is your benchmark. This is really what you're looking for, right? You're looking for a super clear market maker cycle. And then you're looking for that cycle, that pattern to appear on the M15 as well, okay? So you can see the Asian box, the blue box there, and then you're going to get, the move out of the box, and you're going to get your M or your W, okay? Second leg at the high or low of the day, all right? That's the typical setup that you're looking for. Okay, so as an example, let's take a look at a live chart example here. You can see this is USD CAD, and we have the H1 chart on the left-hand side. With the market maker picture there transposed, you can see that the cycle, we had a full cycle completed, okay, and now it's reversing and it's doing the second cycle on the way up. All right, now if you kind of like transpose that over to the M15, look in correlation to the M15 chart, okay, where that W is occurring. On the M15, you have the Asian range, the move outside of the Asian box, the false move out of the box, which forms a W at the low of the day, okay? And then you can see that the W continues up and does the 3 pushes up before it reverses in New York session back down into the range and consolidation. Okay, so if you understand the market maker cycle and you understand what to look for in your setups, you can catch these moves and make some nice pips. This trade here was, looks like a little bit over maybe 60, 70 pips that you could have caught on this move, just for understanding the cycle and knowing when to enter the trade, right? And looking for the signs. Okay, so now you got to learn to recognize the variations, because like I said, it would be too easy if I just showed you this pattern and say, this is what you need to look for, and then you just look for that, right? Because obviously the market makers have to switch things up, okay? They can't just make it easy like that and let you exploit them and run them over. So they know that, right? They know that they have to change things up. So you got to also recognize that they will also change things up. And they'll change things up by changing the times. It might not always be out of the Asian box. It might not always be at the start of London session or New York session, right? they'll change it, they'll shift it, they'll test your patience, right? They'll hold the level for longer than you think, right? They'll do a lot of things to kind of trip you up. But as long as you know where you are in the cycle, as long as you understand the big picture and what's going on, okay, you can kind of figure out, their moves and predict what they're going to do. Okay, so there are a couple variations of the pattern I'm going to show you. Okay, and there's generally three types. So the first type that we talked about, okay, is really the type 1 pattern, which is the move out of the Asian box. You're going to look for the second leg, at the high or low of the day. The second type is where they don't move out of the Asian box. They kind of just stay at the top of the range of the box. Okay, and then that's also a similar move, but they don't go out of the Asian box to make that stop on that false move. All right, then there's a third type where they'll kind of stay in the middle of the range of the Asian box. Okay, and then you look for the second leg there, and it'll continue down. And obviously, conversely, there are also buys that correlate with the same type of behavior. Okay, so the first type, stop hunt, false move out of the Asian box to the low, second leg W and take it up. Type 2, out down to the bottom of the box, the range. Okay, and then the third type is in the middle of the box. All right, so I'm going over these pretty quickly, and obviously in other videos later on, I will be kind of going into more in depth so that we can take a look at these different variations. But I'm going to show you a couple examples right now on the live charts, so that you guys kind of have an idea. All right, so this is a type 1 example. Okay, this actually happened last Friday on Euro Odd. Okay, so you can take a look at the H1 chart on the left here. We have an M that has formed, okay, on the H1. So our bias here is that we're looking for reasons to go short, right? We're looking for short trades to take here. So we jump down to our M15 chart, and we can see out of the Asian box, it has done that false move at the top there. And what's nice here is you can see a couple wicks, right? If you see those really long wicks there, that's a sure sign that the market maker is inducing traders to go long at that point. But then they took it away, right? Then they snatched it away. They came back down, and you can see the second leg of the M right there at the start of the Asian session, or the London session, and then they just went straight down and away, right? So you would have been, if you were able to catch that on the second leg, you would have been instant profit. And made some nice pips on that. Okay, so that's a type 1 example. A type 2 example here was also on GA on Friday, GBP Aussie dollar. Okay, same thing. H1 cycle, we're looking for shorts here. We got a short bias, so we jump down to our M15. Take a look at the setup. Right out of the Asian box, you can see here that it moves right to the middle of the range, okay, and then shifts down. And then if you were able to take that on the shift candle there, once you see that big shift candle happen, that shift out of the zone, that's usually a good sign that you're good, right? So if you were able to take that trade after the shift there, you would have rode that down for a very nice 100 plus pips. Okay, that was a very nice move on Friday for GA. Okay, and then our type 3 example here is on our friend GJ. Okay, so you can take a look, H1 cycle, looking to take shorts. And if we jump down to the M15 chart, take a look at our Asian box. Okay, we have the middle of the range, okay, M right there, and then we take that trade short, and that would have been also another nice 50, 60 pip trade. All right, so these are the three different types of examples the different variations that can happen. So these are the things that you can look for on the charts to take your setups. Okay, I will be going over, like I said, in more detail, trade setups. Okay, how to look for the trades. Also the different indicators that I'm using on the charts to help me identify the setups, the EMAs, and also the TDI at the bottom there. And I will be going over in another video, the part 2 video. Okay, so stay tuned for part 2, guys. But this was just an overview today on the market maker cycle, and just an introduction to get you guys to understand, what it is and what's going on. So if you're able to, grasp the concept and learn this method, okay, you're going to be able to improve your trading a lot. Okay, you're going to be able to trade in line with the market makers so that you're never really in the wrong move ever again. All right, guys. So I hope you enjoyed that, and stay tuned for part two, as I said. And hope you guys are, enjoying your trading week and having a good week. So I'll see you guys in the next video.